Hello everyone, welcome back to the Ergo Prism YouTube channel. First of all, I want to thank you all for the amazing support you've shown me with my first video. That was more of an introduction to Ergo block rewards and sort of EIP 27. Today I would like to make a more intermediate video and then maybe down the line a more advanced video. So it'll be a three-part series, right? First, we had the beginner. Today, we're doing intermediate and getting more in depth with mining and the block rewards. And at a later date, I'll get into the nitty gritty of GPU memory requirements and block heights and difficulty and the network and things like that. So here we go. So much like the first video, I have sort of a web page format, like a PowerPoint slide. I'm going to go through each web page and describe a few things of why I picked them out to help get to understanding these block rewards better. And I think by the end of the video, even if you understand them well, I think you would have found a lot of the information helpful, and I'm sure there's things in here that you may not have realized. So in one take, here we go. So first of all, again, I like to preface everything with a bit of history, and that includes commodities and Bitcoin as an intangible commodity. Intangible meaning that it cannot be perceived with a physical presence. You can't hold it into your hand. So Bitcoin being digital gold or storage of value would be considered an intangible commodity. So first of all, what are the top 10 commodities in the world? It would be crude oil, Brent oil, coffee, natural gas, gold, wheat, cotton, corn, sugar, silver, copper. Many of these you already know. In terms of precious metals, it would obviously be gold and silver and perhaps copper on this list. And that is it for that webpage. So if we think about mining in the most historical sense, basic sense, mining began with human beings using primitive tools for digging. I wasn't lying when I said I would go back to the beginning of things. So so people used tools. Miners used explosives. I think gunpowder was created and invented in China. So in the mid 19th century, after they got rid of gunpowder or black powder, they used dynamite in order to make it easier to break up rocks and things of that nature to get to the commodity or the precious metal or natural product of nature, such as oil and natural gas that we know today. And at the same time, advancements were being made in motorized mining tools with drills, lifts, and steam power pumps. Okay, Industrial Revolution, they kept improving it, in today's technologically advanced society, mining techniques are always improving. For example, using surface mining techniques, many mining operations are now able to extract over 85% of minerals and 98% of metallic ores without digging a shaft or endangering the lives of workers. Newly developed machines used for grinding and crushing can extract minerals from the earth with less energy than ever before. The history of mining is rich and complicated. Mining has led to great advancements for society, but the dangers of mining have also resulted in the deaths of many workers. As technology continues to advance, however, mining techniques become even more accurate and efficient. And in the future, revolutionary technologies may eliminate the need for hands-on involvement from miners entirely. We can argue that we're already there, right? With Bitcoin being the the pioneer to this whole entire digital storage of value being mined with electricity, computational puzzles for block rewards. You're not physically expending the work, but the fuel source that creates the electricity, and obviously the Asics, application-specific integrated circuits, and Bitcoin mining would do the work. So that's very much like a shift between sort of like mining for tangible commodities and shifting that back in 2009 to intangible commodities such as Bitcoin or Erg. Very quickly, so gold is not infinite. Bitcoin is always referred to as a digital gold by most people, even though it was originally designed as a peer-to-peer payment method. It's kind of adopted around the world, this idea of being an inherent storage of value because of the scarcity of this intangible digital commodity. But anyway, gold is not infinite, and how much gold is there left to mine? And I promise all of this will help draw parallels later. So if I go through here, this is from the BBC. Okay. Gold mining production has flatlined. Yearly production in tons. So it's about, 3,500 tons per year in production. Source World Gold Council. I didn't even know we had one of those, but okay. How much is left? Mining companies estimate the volume of gold that remains in the ground in two ways. Reserves, gold that is economic to mine at the current gold price. Resources, gold that will potentially become economic to mine after further investigation or at a higher price level. Interesting. The below ground stock of gold reserves is currently estimated to be around 50,000 tons. To put that in perspective, around 190,000 tons of gold has been mined in total. So based on these rough figures, there is about 20% still left to mine. So if we begin drawing parallels to physical gold, there's about 20% left in the world to mine, and Bitcoin is more of reaching 85% right now, if not already. So there's 15% left to mine. But the difference between these two things is that Bitcoin has only had, 12 years for it, 13 years for it to start from nothing and get to 85%, whereas gold historically has taken centuries, right? And I will get more into that later. But that's very important to note, the differences between physical gold and this digital gold, and the elapsed amount of time that each of them has taken to get to the point where the proof of work or the physical work basically has rendered the remaining available supply of this commodity to be mined, to be taken up from the ground or taken, with a logarithmic equation, such as in Bitcoin's case with the block rewards, halving every 200,010 blocks. So it reaches that height, Bitcoin cuts in half. 210,000. So that is very much artificial, whereas physical gold is a different thing altogether. But nevertheless, technology has to improve. The demand has to be there. There has to be a historically proven value given to this commodity over time that shows that it can perform against other things that we can also take out of the earth, right? Sort of increase in value. Don't sell it during economic hard times. People always say buy gold historically, buy silver. And now they're saying the same things about Bitcoin. So anyway, we're going to get into Bitcoin halving explained. I talked a bit about that in the last video. This is from CoinDesk. So the last Bitcoin halving took place on May 11th, 2020, and the next Bitcoin halving will likely occur in 2024. But I'm sorry, it's been a long day. But what is the halving? How does it affect the price, and what does it mean for miners and the cryptocurrency's long-term prospects? Okay, the halving. In May 2020, the number of Bitcoin entering circulation every 10 minutes, because Bitcoin block rewards are every 10 minutes, creating 144 unique opportunities for block rewards to be dispersed, right, amongst miners. So May 2020, it dropped by half from 12.5 Bitcoin to 6.25 per block reward. Okay, it's a milestone that was easy to see coming because it happens every 2010. Why can't I say that? 210,000 blocks, approximately every 4 years, and has happened twice before 2020. Okay, the allure of possible riches is what draws so much attention to these events. The number of new Bitcoin entering circulation shrinks, but demand should, in theory, stay the same, possibly driving up the Bitcoin's price. And so the event has inspired passionate debate about Bitcoin price predictions and how the market will respond. The theory is that there will be less Bitcoin available to buy if miners have less to sell. So this is, again, a logarithmic equation built in the Bitcoin protocol. Nobody can ever change it. And it basically leads to a brutal cutting in half of block rewards every 4 years, despite the amount of competition, network difficulty, electricity, and proof of work exerted. It will always be cut in half every 4 years until the year 2137, around there. Okay, I'm not going to go through the whole entire article, otherwise we would be here all day. So the block reward is an important component of Bitcoin, one that ensures the security of this leaderless system. As the rewards dwindle to zero in the decades ahead, it could potentially destabilize the economic incentives underlying Bitcoin security. So here's another chart by CoinDesk. I'll let you guys look at that for a moment. If you look at the black line, we're reaching the point really by 2028, and I have a few other illustrations I'll show you in the next web pages, but we're really reaching the point where we're getting not only to 19 million Bitcoin. By 2028, we're basically done with, we're on the 20th million, if that makes sense. So by 2028 to 2130, whatever, you're talking about the final 1 million Bitcoin being mined and the rewards being cut in half every 4 years. So really, we've reached like peak supply, 93% or so within the first 20 years or so, 19 years by 2028. Shortly after releasing the Bitcoin white paper, Satoshi Nakamoto summarized the various ways their chosen monetary policy could play out, pondering the circumstances under which it could lead to deflation when a currency's purchasing power increases, or inflation when the prices of goods and services purchasable with the currency increase. Very important to note, you got to give the guy a break. At the time, Satoshi Nakamoto couldn't have known how many people would use the new digital money, if anybody at all. They elaborated very little on why they chose the particular formula they did. Coins have to get initially distributed somehow, and a constant rate seems like the best formula. So basically, again, if you remember from the first video I made, 50% of Bitcoin supply was basically dispersed into the internet, the digital realm within the first 4 years, right? That's half. But yet for the next 100 years, people are fighting over like 7%. That gets cut down. So if you really think about it, what would the block rewards be like in the year 2140? Well, now you're really not even talking about like even 5%. You're talking about like fighting over the second half of the century for what, 1, 2, 3%? It will be on the following webpage with a more accurate illustration. So where I'm getting at with all of this, I'm building up to a point where are these Bitcoin rewards sustainable? And we're going to get a bit into the transaction fees that are very expensive. If you look at the amount of electricity they consume per transaction is over 100 US dollars. And our transaction fees on Bitcoin's network, enough of an incentive for miners to continue mining when basically the block rewards become so minute, so microscopic, if you will. But yet the security in a proof of work setting, which has this high security assumptions, also need miners to have the incentive to stay around and hang around and continue mining with the promise that there will be something worthwhile at the end of it. Hence, an incentive. Okay. For better or worse, Bitcoin is a bit different. For one, the supply schedule is all but set in stone. And they're comparing it to the US dollar and the Federal Reserve. Okay. Another unique aspect of Bitcoin is Nakamoto programmed the block reward to decrease over time. That is another way in which it differs from the norm for modern financial systems, where central banks control the monetary supply. In stark contrast to Bitcoin's halving block reward, the supply of the dollar has roughly tripled since the year 2000. Okay. We're finally going to move on here. How does halving influence Bitcoin's price? And later I'll connect every single dot, I promise, with how this affects Ergo and things of that nature. Take a quick look at that graph. Okay. You can see the dates of the block height being reached of 210,000 up here back in 2012, 2016, and May of 2020. So it's worth noting that it will not always hit the exact same month every 4 years. It's not exactly every 4 years, but it's approximately every 4 years. You can see down here the year prior to the halving, year after the halving. So you can see even back in 2012, I mean, arguably I always argue that Ergo right now, with the initial block reward being 75, the Ergo Foundation taking 7.5 ERG off that block reward for the first 2 years. I argue that basically if we're at 66 ERG right now in early March of 2022, we're more in the 50 Bitcoin per block reward era. We're just getting all the ERG out there initially, like having a good foundation for that. About 50% of the supply, over 50% is now has been mined and it is in circulation. So we're getting out of that first halving cycle, if you will, in terms of disbursement of ERG in relation to the remaining supply that's left to be mined, right? And you can see that here. I feel like ERG right now at $3.25, not financial advice, but if you look back 10 or so years ago, you can see how Bitcoin's priced. Even though this is well after 2009, just the amount of Bitcoin rapidly emitting from these block rewards meant that it was diluting the buying power of one individual Bitcoin back then. So this is very important, like how the block rewards and the monetary supply work out. And Ergo is the same with a logarithmic equation to make sure it is essentially set in stone, for better or worse, minus of course soft forks that miners participate in exclusively to vote for small changes here and there. But as of right now, we have a very firm foundation, all but fixed in stone, like the other article said earlier, that we know how much ERG will be emitted in 5 years, and 4 years, and 10 years. It's all in the math, and we're going to do a bit of simple math together a little later on as well. And this is where again, stick with me here because I will connect all the dots by the end of this video. So yeah, 2011, 50 Bitcoin per block reward, $2.54. Very, I'm not saying Ergo will be, up there at tens of thousands of dollars with Bitcoin. Maybe, maybe not. But I'm just saying that, you know, right now one token is 315, 325, and it's very comparable if you're really kind of looking at the parallels between these two things. And we can see after every halving how the return, or rather the value of one individual Bitcoin skyrockets. And then you have sort of what's called crypto winter, where from this height we go to a low. And then in anticipation of the next halving, so that would be the later half of 2015, we can see how in anticipation the price begins to go up because people have that block reward predictability built in that it will cut in half and that there will be a supply shock for miners and as well for buyers. And this is the most recent one. So I suppose you could say that whatever currently in 2000, whatever the price of Bitcoin is right now, which is around 38,000 currently, is right here at the top left. You can historically give a good argument that by 2023, which would be a year, sometime 2023, which is around a year prior to the next block reward halving cycle, that Bitcoin will at least hold its ground, if not rise in anticipation of 2024's block reward cutting in half from 6.25 to 3.125. Okay, so enough about Bitcoin. Well, let me wrap up. Why do miners get these rewards? Bitcoin wouldn't work at all without block rewards. There's two parts to making Bitcoin work. Bitcoin's ledger state should answer the question of who owns what and when. And this is how Bitcoin solved the problem that has been as old as the internet itself, all the way, I guess, from the 80s. We have documentation and trials of people implementing a digital money. You had B money, you had Bitcoin Gold or Big Gold, and DigiCash and all these things, eCash. And it has a very rich history, right? All these people, Wei Dai and others trying to, very smart minds trying to sort of create a digital cash, a digital currency, a digital money. But one of the main issues was trying to solve that double spend problem, because just like if I were to send you a photo through email, how do I make sure that you only have one copy, the only copy of the photo, and I still don't possess the original copy of that photo? How do we make sure of that? Well, Bitcoin basically pioneered the idea of cryptocurrency that everybody gets a copy of the full ledger, a copy of the book, if you will, where everybody has a firm account every 10 minutes with these blocks. Blocks act as like a digital receipt, 10 minutes of all the transactions that occurred during that moment in time for 10 minutes. And then a miner is chosen at random, but your likelihood of being chosen goes up if you also exert more proof of work, electricity expenditure, and things of that nature. So it's sort of like a lottery. It actually is entirely like a lottery. So having a high hash rate is no guarantee of mining a block reward all on your own or anything of that nature. So and then mining pools came about and stuff like that. But anyway, that's how Bitcoin solved it. Proof of work helped to solve that, and Bitcoin has never been hacked. So it has really the highest security assumptions and proven security as well. If you have a decentralized hash rate, so you can prevent 51% attack and things of that nature. Overall, Bitcoin has never been hacked, and proof of work and proof of stake is something a bit newer and it hasn't been time tested, if you will. I don't know if I should bring this up, but I'll bring up like one of the hypothetical scenarios with Cardano, for example, or ADA. There is this idea that one of the possible problems that can happen, apart from like right now there's like a civil war in the Cardano community between like multi-pool operators and single pool operators, right? If you have enough access to capital, since there is no work being exerted, blocks are artificially produced on the Cardano blockchain, and that is done by delegating, pledging, staking ADA, as we all know. And they are the most, they really researched this, peer reviewed. It is an amazing blockchain that has really put a lot of time and effort before taking a step in confidently and making sure that this is going to have the best security assumptions for a proof of stake network possible. But one hypothetical scenario I've heard, and that could be brought up, is like, okay, so you get around 5% back APY, annual percentage yield, on your ADA delegated, right? Well, what if there's a liquidity provider, a yield aggregator, DApp, that's built on Cardano now that smart contracts are possible? What if the yield aggregator were to give you a higher yield than you delegating your ADA on a stake pool? So let's say they give you 10% and Cardano is only going to give you 5%. Well, you'll probably go with the 10%. Well, the more ADA that's taken out of the stake pools and aren't minting blocks, the security goes down. That's just a very simple scenario. I'm sure that could be fixed, but these are things in proof of stake, for example, when you're artificially minting the blocks this way by delegating of tokens, that we don't know the answers yet. Maybe there's a real problem there. Maybe there isn't. Maybe it just takes time. We don't know. Proof of work, because it has been around the longest, thanks to Bitcoin, we know concretely the majority of the problems that could occur. But there's also unknown unknowns, right? For example, Bitcoin's transaction fees and things like that, that I believe Ergo has solved. Anyway, getting back to this. So double spend, here it is again. So we're done here. Sorry, we're not done. This article was actually very good. So what happens when block rewards get very small or taper off entirely? That is why the periodic decrease in rewards might eventually become an issue for Bitcoin. But miners need an incentive to do what they do. They need to get paid. It's a business. They're not running these expensive electricity guzzling computers for their health after all. But the consequences of the decline in block rewards is that eventually it will dwindle to nothing. Transaction fees, which users pay each time they send a transaction, are the other way miners earn money. The fees are expected to become more of an important source of remuneration. Remuneration? Yeah, what a weird word. Remuneration. Remuneration. For miners as the block reward falls. In a few decades, when the reward gets too small, the transaction fee, presumably will become the main compensation for nodes. I'm sure that in 20 years that there will either be very large transaction volume or no volume at all, Nakamoto wrote. But for a long time, Bitcoin researchers have been considering the possibility that transaction fees won't suffice. For one thing, it means transactions might need to grow more expensive over time to keep the network secure. It's impossible to predict what will happen, but if we want a system that could last 100 years, we should be ready for the worst case scenario. This cannot really work without very expensive transaction costs because Bitcoin cannot process huge quantities of transactions on-chain, right? And then you get into layer 2s, you get into Taproot and sort of these soft forks that get passed every couple of years that try to alleviate these problems, right? You had 2016 or 17, you had like this civil war between Bitcoin and then what became Bitcoin Cash. Over the size of block sizes, right? There's a lot there. I don't want to make this whole entire video about Bitcoin. Anyways, like I said, the Bitcoin community would probably have to do something. And the person describing this transaction fee crisis that could happen in the future, he hopes transaction fees will be enough to incentivize the security of Bitcoin in the end, but he thinks it's worth anticipating the worst case. Okay. The worst case is demand for block space does not increase in the dramatic fashion that will be needed. As a result, block rewards will eventually trend to zero, etc., etc., etc. So very lengthy article, a lot there. I'm going to very quickly go over this Bitcoin Magazine HODL model hypothesis here. So it's basically using Glassnode, which is a great on-chain metric analyzer. It gives you a lot of great graphs. So you could go to glassnode.com, Glass, Node, and they have subscription models and things like that. But some metrics are free to view, and they are very good. They're very, very good. It's like it's all metrics, and basically, so this is a Illiquid supply quantification and analysis tool, okay, that was developed. So they define illiquid supply as entities that hold over 75% of the Bitcoin they take in. Interesting. Highly liquid supply is defined as entities that hold less than 25% of the Bitcoin they take in. Okay. And liquid supply is in between, apparently. Okay. So the HODL model hypothesis is that Bitcoin has crossed a historic inflection point where the asset's illiquid supply it's outpacing the rate of new supply issuance. Future halvings with lower supply issuance will only exacerbate this divergence. Illiquid supply as a percentage of circulating supply will grow in a parabolic fashion as Bitcoin's digital scarcity drives investor behavior towards store of value as the dominant use case. As a result, they predict illiquid supply will approach 80% of circulating supply by 2036, meaning that basically people are buying Bitcoin and they're storing them off exchanges in their own wallets, and it's basically, again, being used as a storage of values. It has no activity. It's not being introduced back into exchanges, not being sold, and things of that nature. People are holding on to it, sort of like a housing market crisis that we saw with COVID, and at least in the US, where the prices of houses went up so much because there was so little supply and inventory on the housing market, and people wanted it. So they were willing to pay more, they were willing to do cash offers and things like that. Okay. We have a little graph over here. I don't want to get too far into it, but all of this information is, no pun intended, golden. So we could see the illiquid supply, people just taking it off exchanges, buying it, not using it, not introducing it back, and selling it for dollars or whatever, fiat currency. And then we have, we have all that. Okay. At the time of writing, which March 7th, 2022, this is a brand new article. At the time of this recording, at the time of writing, March 2022, illiquid supply accounts for 76.22% of all circulating supply, totaling 14.5 million Bitcoin. This is the highest illiquid supply percentage of circulating supply since December 2017. Okay. They have equations for the HODL model. Kind of a cute name. And final graph here. So they believe we're at an inflection point, and we have this curve of the HODL model, and the illiquid supply will continue to gradually increase. And every halving, as Bitcoin supply goes lower and lower, the HODL model predicts that more people will have illiquid, will add to this chart more illiquid supply versus supply floating around for sale. And they think it will be parabolic because of that. It's hard to argue with that, by the way. So I'm not for or against this case. I would probably I'm actually for this case, that Bitcoin will increase in price due to scarcity and more people adding to the illiquid supply. Okay. So remember, 2024, we're going to go down to 3.125 Bitcoin. And then in 2028, we're going to go down to 1.56 Bitcoin. This will all draw parallels to Ergo, I promise. Approximately 164,000 new Bitcoin will be issued per year during our fourth halving period, which, again, 2024 to 2028, this is how much will be annually produced, mathematically. And cut it in half, 2028 to 2032, 82,000 Bitcoin. Okay. We're going to keep going and going and going. So they are obviously Bitcoin maximalists. They're called Bitcoin magazines. So take what they say with a grain of salt. But that's that. And we're almost done with Bitcoin, I promise. Here are the illustrations I talked about earlier. Here are all the years. It's very nice to see it all mapped out like this. This is the Bitcoin halving cycle. Okay. Every block, every 210,000 block. And the block rewards, total mine, percentage of total mine. So like I told you, in 2028, we're basically dealing with 3.115. Did I get that right? 3.125% is all that will be left to mine of Bitcoin beginning in 2028 when that halving occurs, okay? And look, from when do we hit 99%? 2036. 2032, we hit 99% supply of Bitcoin. So we're literally fighting for the next 100 years over 1% of the supply. I personally don't think that's sustainable. Not financial advice, but come on. Logically, right? So, oh my God. Finally, we'll get into transaction fees. I feel like this video has become more about Bitcoin than Erg, but it will make sense. There is a light at the end of the tunnel for the Ergo community here, I promise. Same chart, but here you can visually see what people are allegedly going to fight over with increasing network difficulty and more ASICs and more electricity. This is supposedly the amount of Bitcoin they're supposed to fight over in the near future. I think around 2048 or so, this is when we're beginning to get really ridiculous. Maybe even if you're in a mining pool, I mean, this is all the block reward, right? This is not even assuming that you're in a mining pool, you get a percentage of the share. This is the entire block reward. If you were to solo mine and just guzzle them up, this is, in that sense, around 2040 or even 2044, we're beginning to get a little ridiculous with how little Bitcoin is supposed to be distributed and people in these big businesses are supposed to fight over. So that, I mean, we're quite a ways off, but this is supposedly the digital storage of value, and this is supposed to be sustainable. Maybe with enough hard forks it will be, because we have a scalability problem. I think we all saw that coming. So the scalability problems refers to the limited capability of the Bitcoin network to handle large amounts of transaction data on its platform in a short amount of time. Okay. Yes. You can look at the number of transactions per month on a logarithmic scale over here on the right. Okay. We have block limits, right? 2017, ideological battle over Bitcoin's future that results in Bitcoin Cash. They didn't want to increase the block size limit, I believe. Yeah. And the block size matters because it you can increase transaction fees apparently that way. Or rather, if you don't increase it, it could result in increasing transaction fees in the late processing of transactions that can't be fit into block. That creates congestion. We all know what happened with Ethereum. Not a good idea. Um, but again, we have a monotonic, I suppose, UTXO model with the way Bitcoin handles transactions, and Ethereum does the account-based model, which is significantly worse um, in terms of the congestion and gas fees and things like that. But at the time, they were trying to pioneer and incorporate smart contracts in a cryptocurrency setting. So I give Ethereum a pass because they were also innovators, and we can't forget that. Ooh, I know in Ergo we have a big focus here on Schnorr signatures and Merkle trees and all that. This is all very cryptographic development talk that I don't know too much about. But yeah, you got layer 2 systems that we all know, Lightning Network for Bitcoin to take it sort of off chain and process it quicker, not increase congestion on the layer 1 blockchain of Bitcoin. Okay. And finally, block size limits determines how often a new block is added to a chain. Block size determines the amount of data that can be added with every block. Bitcoin has a block time of 10 minutes and a block size of 1 megabyte. Okay, so that should be it for Bitcoin. No. Transaction fees, we'll go through this very quickly. How this is a problem turning into a problem. Bitcoin now works essentially how markets work, because if you want something to happen faster, you have to pay for it. Transaction fees are not part of the original system, they just evolved. A system that's designed by a computer scientist for security problems may not be well designed to trade in the market, so the development of fees is actually a good thing, but it's also created all kinds of problems. While the fees help some deals get processed faster, the cost could make most transactions impractical. For example, to use Bitcoin buy a $4 latte at Starbucks, you might have to either wait several hours for the purchase to actually go through, or pay $5 to speed it up, or use like a layer 2 or something like that. One of the biggest challenges for Bitcoin has been that the fees are too high for it to be used as a simple transaction account, and it takes too long. This is from 2019, by the way. Number of Bitcoin transactions that can be added in any given time is orders of magnitude smaller than, say, Visa cards and things like that. Okay. Who they're quoting here in the article compared the fees to a parade in which one onlooker stands to get a better view, causing all the other onlookers to stand too. That's an interesting analogy. If everyone is standing up, you're not seeing any better than you were when you were sitting down. And if everybody's paying a transaction fee now, then you may end up in the same situation that you were in before. The fees got high and you have to wait anyway. Another problem with the transaction backlog in this kind of ASIC written proof of work setting that Bitcoin has is the amount of energy it requires. Blockchains are notorious consumers of power, supposedly. I wouldn't say the majority of them. It's kind of generalizing blockchains. But running Bitcoin for a single year uses the same amount of energy as all of Switzerland. Mathematical problems miners solve to add transactions to the block use enormous amounts of computing power. And when multiple miners are competing to solve the same problem, the power is wasted. Only one miner gets paid, but all the others use massive amounts of electricity. And with more fees, mining becomes more profitable, which then induces more miners to enter, which then uses more electricity. So they were testing their model. They had an economic model to kind of explore the rise of transaction fees and the impact they had on the Bitcoin ecosystem. And they were using data from Bitcoin transactions and validations of nodes between 2009 and 2017. So are we done? Okay, fine. This is it. So finally, Bitcoin average cost per transaction. It is currently, per transaction, nearly $200 for a single transaction on Bitcoin's layer 1 blockchain. That is basically, in most parts of the world, enough electricity to power your house for a month, or close to a month. Depends where you live, right? what they cost, where they get their energy source from, if they charge you for delivery costs, like in I think in Massachusetts and the northeast of the US, they do a lot of that, and it's super expensive. But because they have like a law, you cannot like do anything environmentally bad, so they get their energy fuel source from Canada, something ridiculous like that. So Massachusetts, for example, I think you had to pay twice as much. One, you pay, let's say, $200 for a delivery cost, $200 for the actual electricity as it goes through substations and makes its way from the power plant through substations to your home. It's pretty wild. Anyway, that's a lot of money for a transaction. And you can see historically how much it's been. Okay, let's see, max. Oh, I'm not allowed to. Paywall. All right, but you get the point. We're at 182. It was like 130, 140. All of 2022 between like 130, 150, and it spikes periodically. Okay. I don't know if I should cut off the video. I probably will not. How much battery do I have left? 9? I can make it. I can make it happen in 9. So we're done with Erg. I'm done with Bitcoin. We're done with Bitcoin. Went through everything you guys understand. Intangible commodities, proof of work, historical sense of Bitcoin block rewards better now. You understand transaction fee problems, a lot of things. So now we're finally going to draw all those connections back to Ergo. So I think this part of the video, since we understood all the history even of mining now, I think this part of the video is not less significant, but it will be shorter just because we covered so much already that this part will be easier to understand now. Okay? Okay. I'll make the video work without the computer dying. Okay, so as you know, I'm on Twitter down here at Ergo Prism. Ergo_Prism, and I had a thought similar to what my community, my fellow community member that is well known here, has said in a tweet yesterday. Chris Ray said, I don't know who needs to hear this, but currently block rewards for Ergo miners is 66 ERG per block mine. That is approximately $154,000 a day period. In about 5 years, block rewards will be at a bottom of 3 ERG per block mine. We talked about that in the previous video. And if it, assuming it maintains the same level of demand, that same $154,000 a day in rewards with 3 ERG per block reward, that brings the price of ERG in 2027 assuming consistent demand, excluding existing circulating supply, but the new ERG at that time, with the same amount of demand, in the worst case scenario, we maintain it, every ERG mined out of those 3 ERG per block reward from 2027 all the way to 2045, 2047 will have mathematically every single ERG a price of $71.50. And you can see down here, I said, I've decided to make a continuation of my first YouTube video on block rewards. It seems you scratched a very important surface. Stay tuned. Okay. How much time do we have? I don't even know how long the video is. I hope it's not too long or boring. If so, I'll cut it in half and make one about Bitcoin, second half about ERG. Whiteboard calculation time. This will be very simple calculation. We'll go over here, bring up our calculator. So right now, we can do this. It's the same thing. ERG is proof of work. It operates on block rewards. They taper down over time, but there's no halving cycle. Instead, we have an improvement on that, where instead of cutting in half and creating that supply shock I talked about in the previous video, we have a gradual decrease of block rewards. All right, every 3-4 months, we decrease it by 3 until we reach now a bottom of 3. With the IP27 passing, which if you want to know more about that, check out the previous video. So So here we go. Right now, erg is about, for simple math, right? It's between $3 and $3.25, around there. So, well, first of all, block times on erg block rewards are 2 minutes, approximately every 2 minutes. So there's 100, and I'll do it from the beginning. Why not? 60 minutes in an hour, 24 hours. You have 1,440 minutes in a day. Erg block rewards are not every minute, they're every 2 minutes. So we would divide that total amount of minutes in a day by 2, and that is approximately the amount of unique opportunities miners have to mine erg per day. And the current block rewards are 66. So that creates about 40, I rounded up to 50,000, but really it's about 47,520 erg being minted per day, right? So if we were to take that and multiply it by a nice clean number like $3.25 per erg, as you know, the current marketplace price, let's say. Well, that's where you create $154,440 out of mining erg per day. Now, if we were to take that same equation and push it with the block rewards that will begin in 2027, which is 3, not 66, we'll do the same thing. Total amount of minutes in a day, divide by 2. Block times are 2 minutes, right? And now we're going to times that by 3. Boom, we went from 47,000 whatever 500 erg being minted and adding to the inflationary supply that's hard capped at 97.7 million erg, right? So after 5 years, in 5 years time, we're going to go from 47,000 erg, 47,500 erg down to 2,160 erg per day. And that will be level, the baseline block reward from 2027 all the way through nearly 2050. Okay, after that, no more block rewards, no more erg to be earned by mining, but the ecosystem will be robust enough. Miners have a lot of voting power, so there's going to be unused storage rent when, instead of you dying with your Bitcoin and you have it on a forgotten wallet in the middle of a landfill like that one guy in the UK, the erg will have every 4 years, basically the extended UTXO boxes that are inactive, there'll be a small tax. So basically it is paying for storage rent. If you don't reanimate those UTXO boxes, basically 0.14, 0.13 erg will be taken from that wallet and will be recycled back into the ecosystem for Ergo miners to mine it. So no ergo is ever lost. No erg rather is ever lost. So that will help sustain miners, and by 2050, you best believe there's going to be a lot of people that forget about their erg, or unfortunately pass away, or forget their passwords and seed phrases. And then also transaction fees. So the more dApps, the more ecosystem growth. You can imagine, in 20, 25 years, what type of growth will be. We saw Cardano go from 2017 to launching all the way to 2021. And finally, when they integrated smart contracts and they had a lot of visibility, they were a top 10 cryptocurrency. Now we have hundreds of dApps coming online in Cardano, whereas before there were none. And Ergo it's exponentially growing in the dApp sector. So all those transaction fees, that's what miners will get instead of the actual erg token. So they'll still be able to do it for a profit, to mine as a profitable business. So anyway, we have this, right? This will be the total block rewards in erg for miners per day, right? Now, if we take, we take that $154,000 per day that we currently produce in US dollars now, right? We take assuming the worst case scenario that we just have a steady, even demand from early 2020 in terms of the amount of the market value of each ERG token that it adds to the circulating supply, and we change nothing else, right? $154,000. That's what we currently have in US dollar value being produced every day on the blockchain. Okay, and we divide that by the block rewards that people will begin to receive in 2027 for the next 2 decades thereafter. This is the price in US dollars for each ERG token. From 2027, the new ones, the ones when we're about 84, when we have 85% of the circulating supply already by 2027, this is what every single ERG token mathematically would be worth. Assuming consistent demand, baseline demand of $150,000 worth of ERG today that's currently being produced. This is what each individual ERG token being added to the circulating supply would be worth. So let's say the total, the price of an individual ERG token is under this number of nearly $72, right? Well, this, because of scarcity and consistent 2022 demand levels of 154,000, right, dollars, and the scarcity of the ERG rewards, block rewards, this number essentially acts as gravity, attracting, if the number is lower, right? Let's say ERG is only $30 or 20 or 50. Well, this number every day will be bringing up the value of the circulating supply, almost like pulling it like gravity. Like if the circulating supply is the moon and the earth, well, and then the moon would crash into the earth. You get what I mean? The gravity, the gravitational pull of this price would help to every day be bringing the price of the circulating supply, those coins, ERG coins, already in supply from pre-2027, would bring it closer to this price of nearly $72. Minimum, maintaining a consistent demand of what is currently being produced in the marketplace now. 66 ERG times 325. Okay, I'm sorry, 47,000 ERG, right? 66 times the 720, block times the 2 minutes, right? And we times that amount of ERG currently by the market price of 325. This put into the block rewards of 2027 onward would be about $72 per ERG token. I didn't draw anything on this graph. I explained it all, but I hope you guys got it, because we're moving on. I don't have too much time before my computer dies, right? Okay, so finally, remember, because ERG can be mined without, it's Asic resistant. It's not only that it is mined with GPUs, is that it is a non-negotiable that it can be mined with anything less or more, right? Minimum memory requirements on the GPUs right now for ERG are like 3 or 4 gigabytes of VRAM, right? And that'll increase over time with network difficulty. But basically, you can't do it with CPUs, you can't do it with ASICs. You got to be right in this nice middle ground of GPUs. So basically, it's impossible to stop proof of work mining in Ergo's ecosystem, because ASICs are, Bitcoin mining is essentially a centralized ASIC mining farm that is very easy to see through electric bills and literally big warehouses physically in the real world to see who's doing what in terms of mining. We saw China crack down on Bitcoin mining, and I mean, you can't get everybody, but you could get most of them out if legislation, your government were to knock out proof of work mining, like the European Union, their parliament or whatever was trying to hold a vote for that. They did twice, it got turned down. But even in the worst case scenario, let's say they ban proof of work mining, you can't ban GPU mining, you can't ban ERG mining, because basically every computer, every gaming computer or whatever, those parts, all of that is used in other use cases other than just mining ERG. You see what I mean? So ASICs have only one purpose: to mine Bitcoin or hard forks of Bitcoin like Dashcoin or Monero and things of that nature, right? But you can't ban GPUs because they're multi-purpose and everybody basically can have one. And If you think of a YouTuber streaming video games, they could be playing games in the morning or the afternoon, earning a living doing YouTube and mining Ergo at night. Anybody could participate as long as they fulfill the minimum GPU VRAM requirements. Again, around 3 gigabytes, soon to be 4 sometime soon, maybe in the next year or two. So anyway, here are the Ergo mining pools. So it's important to prevent a 51% attack that we try to decentralize this as much as possible. So far, it's been doing a great job, but if you are a nano pool, please try to delegate your hash power to a different pool so we can have true decentralization of hash rate and everybody can produce blocks in a mining pool that, or solo mine it if you can, but in a mining pool, relatively consistently find these new blocks. And you can see over here, I'm on mining pool stats.stream. And here, if you type in Ergo on the left, Ergo, you'll see every major pool in the last time they found a block and their total hash rate and total percentage of what they make up. So right now, hopefully Nanopool keeps going down, maybe Hero Miners as well, and we get some of this hash rate even more divided amongst this pie. Forgive me for going, relatively, fast. I might sound like a mess, but I'm trying to finish this video before the computer dies, right? So real quick, Ravencoin, which is a hard fork of Bitcoin, also Asic resistant. They had their halving from 5,000 Ravencoins to 2,500 back in January of 2022. Okay, apparently around January 10th. And if we go back to coin stats over here, if I can find that real quick, January 10th. So right around here, end of the year, beginning of January, you can see that this, in anticipation of the halving, just like we saw in the previous Bitcoin chart, in anticipation, the price went up to sort of compensate for the halving and the half of the amount of coins being in the block rewards, but it kind of backfired because now Ravencoin, because it doesn't have any real utility and it's just a hard fork of Bitcoin that's ASIC resistant, basically the price fell, and Ravencoin is relatively unprofitable compared to pre-halving. But this is another reason to avoid halvings, I suppose, because it's just a supply shock and you're gambling on whether miners are going to continue mining or buy it off the marketplace. In the case of Ravencoin, as of right now, their halving actually went against them. So it's better with, to taper off rewards in the way that Erg block rewards do. Bitcoin mining is a competition of sorts. Miners are essentially racing to be the first to add new blocks to the blockchain. For each block added, they receive a certain number of new Bitcoins as a reward. The originator of Bitcoin programmed the block reward to be cut in half at regular intervals. Looks like this webpage actually was something that I was going to add in. I should have put earlier on. But anyway, there's going to be 64 total Bitcoin halvings, and by 2140, they will all be over. And then finally, how much I got? I have plenty of time. Okay, so finally, not only did I focus on Bitcoin to summarize, just because it's important to see how we got to this point in the crypto industry and the security, how block rewards function, especially since Ergo functions in a very similar manner. It's not only that, but it's also because until we have a complete decoupling of prices of, I hate to use the word altcoins, but let's call it for what it is, altcoins. Until we see a decoupling between Bitcoin and even Ethereum from the rest of the cryptocurrencies in the space, at least the serious competitors, right? Basically, it matters where Bitcoin's price goes because that influences, at least in the near future, short term, what the price of every other crypto currency in the industry, where they go as well. Usually, not always, usually. And that decoupling, I believe, will occur, especially as Bitcoin, the rewards become a little too ridiculously low and people are looking for new, more novel technologies, better technologies that still have the same security assumptions. In this case, Ergo would be the most complete package, right? Taking the best of Bitcoin, taking the best of Ethereum. Even the core developer, Alexander Cherpanoy, made no secret in his mainnet release back in July 2019. He had a presentation. He literally said in the PowerPoint, like, we are taking the best parts of Bitcoin and Ethereum and other things like Oracle pools and privacy tools, and we're going to put them all into this, like, sort of like a platypus, and make it better than all of those other things separately. We're going to combine the best, like a big Decepticon or Optimus Prime, and have every part of the robot be as best as it possibly can be, and addressing the shortcomings of these protocols. Now, remember, Ergo's core dev, while we're speaking on him, he's been in the crypto industry since 2011. He's one of the smartest people in the entire industry that has done academic research and development all at the same time, and has been around basically almost from the beginning of the entire crypto industry that began with Bitcoin in 2009. So finally, if you look here at Bitcoin's halving, I want to go back to that. It was May of 2020. Okay. In anticipation, back in March of 2020, as we all remember, COVID was driving everything down to the ground in terms of global markets. And in anticipation of the halving, Bitcoin recovered from like a low of like sub 4,000, I believe it was. It's not on the chart. And in anticipation of the halving, reaching that, block height, the price went up as well. And as we know, the rest is history. So I thought that was fun to compare. Okay, where are we now? 2%. Okay, thank you for bearing with me. We made it to the end of the video. I was attempting to do an Ergo raffle, which is essentially like a crowdfunding alternative, an Ergo crowdfunding alternative to like Patreon or GoFundMe or something like that. But basically, I figured let's cut all of that out. And if anything that I presented in this video or the previous one was insightful, helpful to you, if you enjoyed it, please consider donating to my direct Erg address. Let's cut out any middleman. Any donation, big or small, helps to support this channel and keep it ad-free. I don't want to have ads, YouTube ads anywhere or anything like that. I prefer to keep it open source, so to speak, even though YouTube is Google's platform, right? But keep the information open source, right? Anybody can access it. And if you would be so kind, if you want to donate, here's my QR code. You can do it with any of the, sort of like common Ergo wallets, Ergo mobile app. What are the other ones? Nautilus. I suppose Yoroi, if anybody still uses that. But yeah, if the QR code doesn't work, try to if you're on Ergo mobile wallet, I noticed that doesn't work immediately, maybe because this is a new Erg address, but try to click on the wallet that you have and then click on the QR scanner in the top right corner while you're inside the actual wallet that has a name and everything and a balance. So you click on the wallet and then go to the top right, click on the QR scanner, and usually it works when you do that. So yeah, anything big or small, I really do appreciate it. That helps to support the channel for future videos as well, educational stuff. So please consider it. It would help a lot and motivate me in the future to continue everything ad-free and open to the public. Finally, feel free to follow me on Twitter at Ergo_Prism. There's also an NFT collection we're working on here. So far, so good. And you can follow that as well if you like. Sigma Village, at Sigma Village. Okay, and we have daily auctions on Ergo's auction house. So yeah. Oh, this one already sold. Haha. Okay, anyway, thank you guys for joining.